Long-term capital management, or LTCM, was a hedge fund established in 1994 by John William Meriwether. LTCM was led by Nobel-Prize winning economists and some of the best traders on Wall Street. It went on to become one of the largest and most successful hedge funds in the 1990s before collapsing in 1998. How did such a successful firm rise and fall in the span of less than a decade? What is a hedge fund? A hedge fund pools capital and invests in assets to generate returns that are not correlated with the stock market. Hedge funds are intended to provide high returns but come with greater risk. They are usually managed by professionals using sophisticated strategies and instruments and may involve the use of derivatives to hedge bets. Hedge funds are typically associated with a high degree of risk and limit who is allowed to invest in them. Long-term capital management was highly leveraged and had complex investments based on complex mathematical models that relied on the efficient market hypothesis. The efficient market hypothesis states that financial markets are rational and all relevant information is reflected in asset prices. Furthermore, it states that it is impossible to consistently achieve higher returns than the market as an investor. Today, many people believe that financial markets are not perfectly efficient, and anomalies can and do exist. Some would suggest this would allow some skilled investors to receive consistently higher returns than market returns over time. Despite this, EMH still has influence conceptually. It is my opinion that it is impossible in a statistically meaningful way to achieve returns better than the market consistently over a period of 5 years or more, especially once the return is less the cost of management fees. Long-term capital management specialized in arbitrage opportunities via convergence trades in bond trading. Convergence trades involve taking advantage of pricing discrepancies between assets that should be priced similarly but are not. LTCM would buy the undervalued asset and sell the overvalued asset, sometimes via short selling. Eventually, the price of the two assets would converge, which would result in a profit. Convergence trading can be very complex and requires a great degree of skill and market knowledge. Traders will often leverage advanced trading technologies and data analysis tools. This kind of trading is still seen today in some hedge funds. Long-term capital management was also involved in interest rate swaps. These are financial contracts that would allow the exchange of interest rate cash flows with another financial institution, whereby one party would pay a fixed interest rate while the other party paid a floating interest rate. The two parties would have to agree on the length of the swap, the notational value, and the fixed and floating interest rates. The purpose of interest rate swaps is to manage interest rate risk. They are highly customizable to meet the specific needs of parties involved, but carry risk associated with the creditworthiness of the parties involved. The spread in a lot of arbitrage opportunities is small. To maximize these small returns, a company can leverage itself, which amplifies the returns, but also the risk. In 1998, LTCM had only about $5 billion in assets, but the positions totaled $1 trillion. And it had borrowed more than $120 billion in assets. Long-term capital management enjoyed a 40% profit in 1996, but in 1997 it was less than half, 17%. The reason profit more than halved was other firms were entering the arbitrage market and decreasing opportunities. In response, long-term capital management began to get involved in even riskier bets like emerging market debt and foreign currency. Some of these positions LTCM did not have any sort of informational advantage in, like Norwegian kroner. The 1997 Asian financial crisis did not affect long-term capital management as much as the 1998 Russian financial crisis. In 1998, the Russian ruble collapsed due to a convergence of many factors, including low energy prices, political instability, and pervasive corruption. Following the collapse of the Soviet Union in 1991, the Russian economy was in a dynamic period of transition as it experienced high inflation, fiscal deficits, and a depletion of foreign currency reserves. August 1998 saw a Russian default on domestic debt, which led to a widespread loss of confidence in the Russian financial system. The ruble devalued in a rapid fashion, whereby 70% of its value against the dollar was wiped out in a matter of months. The consequences of devaluation of the ruble were far-reaching. The Russian economy rapidly contracted in such a way that businesses and individuals were unable to pay their debts or access financing. The result was widespread poverty, as savings and wages were obliterated as casualties of ruble devaluation. The savings of the average Russian were worth pennies on the dollar. It was hard to find a job, and what work could be found paid poorly. The Russian government implemented several economic reforms to reduce inflation and improve fiscal health overall, and specifically the banking sector. Despite the direness of the situation, overall, the Russian government made most of the right decisions in regard to the 1998 crisis, resulting in the country stabilizing economic growth and a recovery in the following years. We will discuss the Russian financial crisis of 1998 on a future video, so be sure to subscribe. Long-term capital management had a significant position in Russian government bonds when Russia defaulted in August 1998. Computer models at the company were advising the firm to hold its position despite hundreds of millions of dollars per day in losses. Massive losses were incurred that risked long-term capital management defaulting. The firm had positions totaling approximately 5% of the total global fixed income market. If the firm defaulted, a global financial crisis would have been triggered. As the losses compounded to almost $4 billion, the Federal Reserve Bank of New York created an almost $4 billion loan fund to help LTCM survive and liquidate in an organized way. Various banks participated, such as Barclays, Chase, Goldman Sachs, and Morgan Stanley. These participants received a 90% share in the fund, while the partners at Long-Term Capital Management received the other 10% stake. The bailout ended the panic, and Long-Term Capital Management's positions were liquidated at a small profit to those who had participated with the Federal Reserve Bank of New York in the loan fund. Although I call it a loan fund or bailout, it was in fact an orderly liquidation supervised by the Federal Reserve Bank with the participation of Wall Street banks. By the early 2000s, the fund was completely liquidated and the banks had been paid back. Remember John William Meriwether, the founder of Long-Term Capital Management? He would launch another hedge fund called JWM Partners in 1998 that would employ some of the same LTCM strategies. This hedge fund would experience a 44% loss between September 2007 and February 2009 that led it to being shut down in July 2009. The explanation for the collapse of long-term capital management is a matter of opinion, as it was the convergence of multiple strategies, circumstances, and events. Long-term capital management was only using 5 years of financials to build models, which excluded the 1987 market crash. Broadly speaking, it had been theorized that a lot of financial models do not incorporate the risk of a black swan or extreme financial event. Some people would say it is reckless to not account for rare or outlying situations given a high leverage position. In addition, quantitative finance is perhaps not as much of a science as some would like to believe, but rather an art or a faith.